Top 5 dividend stocks in the S&P 500. So if you're a dividend investor and looking out for the next stock to invest in as a dividend, stay tuned.
First stock is Kinder Morgan's Inc. KMI is the ticker symbol and is today currently at $16.50. The company is based in USA, Texas. It's an energy company and it has currently more than 10,000 employees. So basically, Kinder Morgan's is one of the largest mainstream companies in North America currently, helping to move oil and gas from where it's drilled to where it's eventually getting used. So basically, they transport the gas or the nutrients from point A to point B. Its profile of pipelines, storage, and processing assets would be virtually impossible to replace later on. So it has a big infrastructure currently a plan. Its business is largely fee-based and it gets priced or paid based on the use of the system, not on the price of the commodity. So it doesn't matter if oil today falls, if oil is up by, if oil barrel is $80 now, if it's 40, if it was like back in Corona times, if it went down to minus $35. The business is based on fees of using the infrastructure basically. Largest energy infrastructure firm in the S&P 500 with a current yield of 6%, 13% owned by the management, and $2 billion stock buyback program. And the currently credit rating grade is BBB, which is not bad. Kinder Morgan owns an interest or operates in North America more than 83,000 miles of pipeline, 144 terminals that store and handle renewable fuels, petrol, product, chemicals, vegan oils, and other products. 40% of the natural gas consumed in the USA is transported through their pipelines. Can you imagine that? 40%. Market cap at 37 billion currently. Trailing PA ratio is at 22 and a stunning 16 forward PA ratio, with a price to sales ratio of 2.6 and a price to books ratio is 2.1, which is truly amazing. With the 2.27 billion outstanding shares, currently with 1.95 billion floating, 11.5% owned by insiders, management and etc., 57% owned by institution currently, and a short interest of 37 million shares. Currently, the dividend yield is at 6.46%, which gives you about $1.07, and the forward-looking dividend yield will move up to 6.50%, which will yield about 1 cent more than the previous. Payout ratio is about 139%, with a 11% profit margin and 31% operational margin for the last 12 months. Management efficiency is at 4% return on assets and 5% return on equity. The revenue currently is at 14 billion in the last 12 months. Revenue per share is about $6. Quarterly earnings growth is $23, with a growth profit of the 12 months $6.6 billion. Currently holding about $1.5 billion as in cash, and their debt is currently at $33 billion with a debt to equity ratio of 100, with an operational cash flow of $5.6 billion. Let's see what the earnings estimates are for the future. For next quarter, the averagely is about 1.27, and for this currently is 1.3. For next year, it's 1.01, which is quite low, but I believe they're going to do much better, around the 1.8 to 2 ratio. 5 analysts put a strong buy and 6 of them put a buy and 8 of them said a hold. And averagely is basically a hold for now, but I believe it's currently at a buy rating for me, with a high price tag at $22 and a low of $15, which average out about $18 currently, which has an increase from current price of 16 to 18 is about an 11% return. Looking at the S&P 500, the current yield per year for the last 30 years is about 8%, which this is basically outperforming and beating the expectations for the last 3 quarters, and which I believe they're going to do it again for this quarter on the 19th of October.
and getting quite of a high revenue and increasing revenue over the last 4 years. Except for 2020, the earnings went down less because probably the pandemic and people were lockdowns and work from home, so less cars, less industry, less gas and less oil was being used, so that's why it was a decline. But for this year, we're gonna see a big jump up from last year.
For me, an important aspect as well is checking who's the holding institution. BlackRock about owning 8%, with second being Vanguard Group, and JPMorgan about 1% owning it. I definitely look into these because it kind of shows me what companies are interested in currently. And BlackRock and JP Morgan's and Vanguard are usually really good investment institutions, and they definitely don't want to lose their money. So it's a good sign, kind of, if you see them owning these stocks. So basically, everything being said, from 6% yield to $18 price tag, to BlackRock and big corporations owning it, and with a 2 billion share buyback program, this is a good buy. Our second stock is Chevron Corporation with a ticker symbol of CVX. Its current price tag is about $100. Same theme, but different company. The oil giant Chevron, which is an oil and gas company as well as KMI. Commodity, as we've seen, commodity prices drive to the top and the bottom lines here, which we can make earnings quite volatile. However, Chevron has the strongest balance sheet in this peer group. The debt to equity ratio is a modest 3.33 times, providing a solid financial foundation. And despite the often materials up and down of the oil prices, it has stringed together an incredible 34 years worth of annual dividend hikes, which makes it basically a dividend king, basically. Management clearly knows how to deal with volatile commodity prices. It's a really good company for now. Let's get into it. With a current market cap of 94 billion and a currently 53.4 PA ratio and a stunning forward PA ratio of 12.9. Can you guys believe that? 12.9 forward PA ratio. With a price sales ratio of last 12 months of 1.6 and a price to book 1.4, which is really good for now. With a total outstanding shares of 1.93 billion outstanding shares, with 1.9 billion floating, held by 0.3 only insiders, and 67% from institution, with currently short interest of 15 million only, which is about 0.8%, which is quite not a lot, so that means people don't bet against it, which is a good sign. Coming in second with a 5.21% of dividends, which currently generates about $5.21, with a forward annual dividend rate increase of 5.33%, which would generate about $5.36, which is about 15 cents more than the previous one, with a payout ratio of 200, almost 80%. With a profit margin of 3% and operational margin of last 12 months of 5.7%, the management efficiency is quite good, a return of asset of 1.7% and a return of equity of the last 12 months of 2.7%. With a currently revenue of $116 billion and a revenue to share price of $61 and a gross profit of $43 billion, with a quarterly revenue growth of 126%. They're currently holding 7.5 billion in cash, which makes it about 3.9 total cash per share. The total debt is 43 billion. So basically a total debt of equity ratio is at 32, which is quite not the best numbers, but it's quite decent compared to the other companies in the same sector, which is quite higher than this compared to KMI, for example.
And the current cash flow statement is operational cash flow is at 16 billion with a leveraged free cash flow of 10 billion. About 19 experts expect an average estimate of earnings of 2.5 for 2.15 next quarter and this current year of 6.74. And for next year, they quite expect an average estimate of 7.8 with a high estimate of 11 for next year, which I believe would be higher than that, which would be for me from a range of all the way up to 10 to 15 from my expectations for this company. Revenue estimate is averagely about for next quarter 39 billion for this current year, which would make it up to 150 billion approximately, and for next year they estimated over $156 billion with a high estimate of $173 billion, which I believe would be about correctly. I think they're gonna make from all the way from 160 to maybe like 180, 190 for next year. So for next quarter's current estimate of the EPS's earnings per share is 2.15 and for this year is 6.73 and for next year about 7.8, which I believe they're gonna definitely reach the 8 S&P mark. So for next quarter's estimates is gonna have an increase of 121,600%. So for this currently, which makes it up from 3,470%. For next year, they have an approximately of 15.7% increase, and then for the next 5 years, they have a minus estimate of almost 5%. So in September, about 6 estimates said it's a strong buy, and 10 of them said it's a buy, 7 of them said it's a hold, and 1 said underperforming. So which would average out about between a buy and hold range, and the current lowest estimate value is at $100 and the highest is at $150 per share, which makes an average of 122.5 cents a share. That's how much it should cost, and it's currently at $100, which is about a 9 to 10% increase of price ratio if it goes to from $100 to $122, which is a decent return of equity. Again, I like seeing Vanguard and BlackRock being on the list, with Vanguard owning about 8% of stocks and BlackRock owning about 7% in stocks of this corporation. As well as Bank of America is owning 1.7% and JPMorgan's as well. Next to it, Morgan Stanley. Big 5 to 6 big firms currently own shares in this stock, which means it's a good sign for me that they own stocks in this company as well. Chevron as well said they would triple its planned capital investment in low carbon business to 10 billion throughout the next 7 years to come, including a 2 billion to lower the carbon intensity of Chevron's operation. Chevron as well just teamed up with a company called Gevo. So Gevo is one of my favorite company currently at $7, which basically Gevo makes renewable fuel from biofuel from corn and other vegan material. So basically Gevo and Chevron put their hands together to open a new facility, which is basically a new corn oil to produce for it aviation fuel. So Chevron would have the right to offtake approximately 150 million gallons per year to market to customers, which is a whopping good number for renewable energy. And not only that, one of the biggest investors and my favorite idol, Warren Buffett, invested in this company. He recently, though, reduced his stake in the company, but probably to take some profit out of it. So his current value in this company is 2.4 billion. He reduced it about 2 billion as well. He had a 4.1 billion stake value in this company in the end of last year. Having said all of this, with all the numbers and the project with Gevo and the dividends amount with the price tags and everything, this is a company you should consider to invest in.
Simon Property Groups Inc., which ticker symbol as SPG with a current price tag of $133, is based in the USA in the state of Indiana. It's a real estate company and it currently employs more than 2,400 employees. So Simon is basically a real estate investment trust management which owns primary shopping malls, dining, entertainment, and mixed of other destinations. And it's operated all the way through North America, Europe, and partly Asia. It owns currently over 200 properties, which are generally well located and likely to end up benefiting from the trouble in the mall space. That's because as in week a mall closes, what happened Corona times, a lot of malls got closed. They took over that. The remaining malls become more attractive to shoppers and retailers to reverse networking effect. With a current market cap of 43 billion, almost 44 billion, with a trailing PA ratio of 28.9, and with a forward-looking PA ratio of 25, which is getting better, and with a price to sales ratio of 9.4 and a price to books of 13.8, which is not the best, but it's okay. With 328 million outstanding shares and 325 of them are floating, only 0.5% is owned by insiders and 90% are owned by institution. And the short interest of it is about 4% with 13.6 million short interest shares. Coming in third with the dividend rate of yield with a 3.92%, which currently generates about $5.30, and with a forward dividend yield of 4.4%, which would generate about 70 cents more at $6. With a payout ratio of 144%, the current profit margin is at 31% with the operational margin of 44%. The currently management efficiency, the return on assets of the last 12 months is at 3.7%. The return of equity for the last 12 months is 50%. The currently revenue is about $4.6 billion and the revenue per share is at $14. Quarterly revenue growth of a year to year date is 18% and a gross profit of $3.7 billion. Earnings estimate for this current quarter, next coming quarter is 1.16 and for the current year is 5.52 and for next year of 5.18 with a high of 5.61, which I believe would be quite much higher due to the vaccination being rolled out now and people who go out more using the malls, using entertainment systems, using everything. So for next year, I believe it could be in the, let's say 5.5 to 6 range easily. Revenue estimated for next quarter is about $1.19 billion and for this current year at 4.63 billion, with the next year of 2022 being 4.75, which is an increase of 2.8%. I believe they're gonna, if everything reopens again and people go entertainment system, go use malls, go shop and all of this, it could be around 4.75 to $5 billion in revenue. Currently EPS for this quarter is 1.7 and for next quarter is 1.16 currently, which is about 152, and for next year it's 1.18. Yeah, I will say it again. I believe that the EPS is gonna be a bit higher than they suggested here or estimating it. In my beliefs, malls are gonna open up again, and people are gonna use their properties, and which basically means higher earnings per share. The current quarter growth estimate is at 122%. For next quarter, only 35%. For this current year is 43% for last year because of COVID, so probably it's a reasonable one. For next year is minus 6.20%. And for next 5 years per annually, they expect to be 8.6% return annually, which is quite the same as the S&P 500, which I would say they're gonna definitely beat this 8.6% mark for the next 5 years. And for next 5 years, probably for the next 2 years in these 5 years, with the average maybe of 10%. In September, about 7 analysts said it's a strong buy, about 10 of them said it's a buy, and 5 said a hold, which would be, let's say, a recommendation rating of a buy currently, with a price tag low of 130 and all the way up to 177, which would average out about 150. From the average price tag to the current price, if you figure out the percentage in between, it's about roughly between 12 and 13% of return. That's without any dividends, without anything else. So with the price tag of returning of 13% and paying out dividends currently with a future expectation of 4%, which is really good. Vanguard owning more than 14% and BlackRock owning more than 10% in this company, with Morgan Stanley as well owning about 1.34%. Honestly, one of the best investments in the world, or all time. It's been always like this. The best investment is always to buy property or land, because this landscape would, in 2050, people are expected to reach 9 billion population, there will always be a demand for land and building houses, and people want to live on the land, or making it a farm land. Maybe in the future they could sell some of these malls, or like for example Amazon just recently bought a mall. Maybe they could in the future buy malls from Simon, or they could make a new experience out of malls, or maybe build it into living residential area or something like this. So there's always one of the best investments in life is always to buy land or real estate. But the issue with land and real estate is it's quite difficult to always start with it, because the amount of equity needed is compared to stocks and stuff is a bit higher than in the stock market, and the returns, you will always have an asset to land on at the back. Our fourth stock today is Kellogg Company, ticker symbol K, currently at $63 a share. And come on, you guys, you know this company. Do you guys remember, or still? Kellogg is basically a company well known for cereal eating and conventional foods. It operates now in kind of 4 segments: North America or Europe. It produces all the way from crackers, cracks, survey snacks, toaster, pastry, cereal bars, protein bars, and much more like Cocoa Pops. It's as well based in the USA with currently more than 31k employees, with a market value of 21 billion, trailing PA ratio of 16 and forward PA ratio of 15, and its price to books ratio is about 1.55, and the price to books is 6.47, which is quite okay compared to the other numbers. With about 340 million outstanding shares, 277 are floating, which makes it a 0.70% held by insiders and 88% owned by institution. A currently short interest is about 20 million shares, coming in third with a dividend yield of about 3.36%, which yields about $2.29, and a forward PA ratio of $3.64. They just increased it by 0.1%, which is not a lot, but it's still a good interest rate on the company's theme, and for the forward growth and opportunities they have. They're definitely going to be paying out dividends, which I would say in the next 20 years is going to be a dividend king among Coca-Cola and other companies. The current profit margin is about 9.27%, and operating margin for the last 12 months has been almost 14%. The management efficiency of return of assets is about 6.5%, and return on equity is about 36.12%. The current revenues are 14.3 billion, and the revenue per share is 40. The quarter earnings growth over year per year is 2.6, which is not a lot, but it's growth compared, and growth profit of 4.70 billion. Holding a total cash of 446 million, and with a total debt of 8.26 billion, which would make a total debt over equity ratio of 212, which is quite high, with a current estimate of 0.91 for next quarter's earnings, and for this year an average estimate of 4.09, and for next year they estimate an average day on 4.18 and a high estimate of 4.38, which I believe they're going to be around the 4.5 range-ish. With a revenue estimate for next quarter of 3.38 billion, and for this current year they're going to have a current average estimate of 14 billion, and for next year 14.19 billion, and with a high estimate of 14.52 billion, which is about a 1.5 to 2% increase from last year's revenue estimates. Which is not a lot, but just remember that this is a dividend stock. You don't invest it for the growth or anything. You invest it for getting dividends. With a current estimate for next quarter of EPS, earnings per share, of 0.91 for this year, which would make it 4.09, and for next year 4.18, which I believe they could be from the range of 4.25 to 4.5 earnings per share. Its growth estimate for next quarter is 5.8%, and for this current year is 2.5%. For next year is 2.20%, and for next 5 years annually over 3.29%. And the past 5 years annually they've been producing 3.70%, which I believe next year it's going to be around 3%, and for next 5 years. Because imagine, we all used to love it as kids. If you have kids, if you have younger brother, if you have nephews, grandkids, nieces, whatever, they all eat popcorn, all these cereal things, they love it. So this company can never lose, kind of. Within September, 2 analysts say strong buy and 1 saying buy, 15 currently saying hold, and 2 saying underperformed, 1 says sell, which would range it around the hold position, closely to the hold position, with a low estimate of $54 a price tag and a high of $76 a high price, averaging out at $67.97 a price tag, which from the current price tag is about 6 to 7%. My personal price tag would be about $70 for this share currently. Again, key investment institutions, Vanguard and BlackRock, are on it again, with the 8% for Vanguard and the 7.2% for BlackRock. And Morgan Stanley owns about 1.24%. The biggest holder is Kelgo WK Foundation, which is probably like a way to basically avoid taxes and stuff like this. So the owners, the original people in this company, they probably own this foundation to basically evade taxes and other kind of things. So this is kind of a structure of how Colgate's, what kind of companies he owns. He owns a lot of companies. Pringles, it, Special Coke, Allbrain, Choco Pops, Tiger, Pretzels. He owns all these companies. Whatever they make, the earnings, the profit goes back to Colgate. So can you imagine how big of a company this is? The management basically of this company has been overwhelming the company's profile in the recent years. Cereal is now just a third of its business, with snacks are roughly about 50% and frozen foods are the remainder. Snacks is just a fast-growing industry segment, so fairly solid decisions that follow along with the customer's demands. Kelgo also has been building a position in emerging African market, where noodles are a key product. So what I've seen last time in TV, in the Egyptian TV channel, the advertisement, they used the national goalkeeper to advertise Kelgo's noodles. They now make like noodles like Indomies. Our last and fifth stock is Dominion Energy Inc. with the ticker symbol D, currently priced at around $75. Dominion Energy is basically a producer and a distributor of energy. The company operates currently in 4 segments: Dominion Energy Virginia, gas distributions, Dominion Energy South Carolina, and contract assets. The Dominion Energy Virginia segment generates, transmits, and distributes generated electricity to residential, commercial, and industrial and governmental customers in Virginia and North Carolina. The gas distribution segment engages in the regulated natural gas gathering, transportation, distributions, and sales activity, as well as distribution non-regulated renewable natural gas. This segment serves residential, commercial, industrial customers, and many more. The Dominion Energy South Carolina segment generates, transmits, and distributes electricity and natural gas to residential, commercial, and industrial customers in South Carolina. The contract asset segment is involved in the energy market and price risk activities. As of December's last year, 31, the company's profile of asset included approximately 30.2 gigawatts of electricity generating, with 10,500 miles of electricity transmission lines and 85,600 miles of electricity distribution lines and 94,200 miles of gas distribution lines. It serves approximately 7 million customers currently. The company sells electricity at a wholesale price to the rivals, electric competitors, and municipalities, as well as in wholesale electric market itself. So they're one of the most competitive and cheapest one out there in this current market. Its headquarters is based in Virginia, USA, and we're currently having 17,300 employees. With a current market cap of 60 billion and with a trailing PA ratio of 26 and a forward PA ratio of 18.6, with a sales price to 4.3 and a price to books ratio of 2.4. With currently 800 million outstanding shares and 807 with 1 million less floating shares, which makes up about 0.27% insiders holding and 68% of institution holding, with a current short interest of 7 million shares. Ranking as well 5th in dividend out of the 5 stocks, with an annual dividend rate of 3.81%, which generates about $2.83, and a forward annual dividend rate of 3.38%, which would generate at $2.52. It's quite a decrease in the future, with a payout ratio of 97%. So in the future they expect to pay out less dividend, with a profit margin of 16% and an operating margin for the last 12 months of 25%. Return on assets is 2.22% and return on equity is 7.8%. With a currently revenue of the last 12 months of 14 billion, which would make a revenue per share of $17.23 and a gross profit of 7.4 billion. Holding a currently total of cash of 200 million, which makes the total cash per share of 0.3 and a total debt of almost 40 billion, which would make a total debt to equity ratio of 147 ratio. With the earnings estimate for next quarter of 0.97 and for this current year with a 3.87. And for next year they estimate about 4.13 with a high estimate of 4.24. Revenues estimate for next quarter is 3.97 billion, with the current year's estimate averagely about 14.93 billion. And for next year they expect to gain 2 billion approximately to 16.22 billion. The growth for next quarter's estimate is 19.8%, with a current year of 9.3%. Next year will be 6.7% for next 5 years, an annual rate of 6.65%. September, with 2 analysts saying strong buy and 2 of buy and 14 saying hold, with a current ratio of recommendation between a near buy point and hold, with a low price tag of $76 to a high tag of $96, which would average out around 84.84 cents, which would be currently from its current price tag and the average price tag, which would make it around 13%. I really believe it in the range. My price tag is in the range, same range, about $85, which is about 13 to 14%. Vanguard again being here, welcome back, with a 8.5% and BlackRock with about 6.69% owning in this company. Dominion Energy Trade Union announced a coastal Virginia offshore wind partnership on the 16th of September, which was about 1 week to 1.5 weeks ago. So the Dominion Energy Virginia and the NABTU and their state affiliate Virginia Building Trades reaffirmed today their commitment to the participation of a unionized workforce in the construction of the coastal Virginia offshore wind project, and also affiliate to their commitment to the utilizing local work, as well as training of veterans, and many more. The coastal Virginia offshore wind project is the largest offshore wind project in the United States and is currently under developing off the coast of Virginia Beach. Once completed in about 5 years in 2026, it will consist of up to 180 turbines and generate up to 2.6 gigawatts, enough to power about 660 houses. A Magnum Economics analysis estimates that the project could create about 1,100 direct and indirect jobs in Hampton Roads and generate about $82 million in pay and benefits and $210 million in economic benefits annually and approximately $11 million annually in local and state taxes. Thank you guys for watching. I hope you enjoyed it and it was helpful and educational for you. Stay tuned for the next upcoming videos and let me know what you think in the comments, and don't forget to subscribe and like and hit the like button.